What's up everybody, I am Jaspreet Singh, and after a record housing market boom in 2021, the housing market is starting to cool off because we have been seeing home sales slowing for 6 consecutive months, and now buyers are walking away from closings at the fastest rate ever, probably because when a buyer walks to the closing table and then they find out that their mortgage is going to cost $600 a month more than what they expected because mortgage rates have pretty much doubled since the beginning part of this year, they realize, I can't afford this high mortgage. This is why some people are now calling it a housing market recession, because the housing market is slowing down and housing prices have been falling in many pockets around the country. Now, this shouldn't come as that big of a surprise considering how fast mortgage rates have grown. If you wanted to buy this $500,000 home in 2021, it would have cost you $500,000. Well, if you put down 20%, that's $100,000 for your down payment, meaning that you are going to be borrowing $400,000 from the bank, and towards the end of 2021, you could borrow this $400,000 at a 2.8% fixed 30-year mortgage, meaning your monthly payments would have been $1,650 a month. Well, now today, if you wanted to buy the same home, assuming no upgrades, no modifications, the exact same home prices are just above 20% higher than where they were before. But if we round down and we say home prices have gone up by just 20%, that means now instead of paying $500,000, you got to pay $600,000. This is a growth in 20% for the same home. That means now if you put down the same 20%, you're not putting down $100,000, you're putting down $120,000. Again, 20% growth here, which means that now you're not borrowing $400,000, you got to borrow $480,000. Again, 20% growth here. But not only are you borrowing more dollars, but you're borrowing the dollars at a higher interest rate because you're not borrowing at 2.8%. Now, if you want a fixed rate 30-year mortgage, you're paying close to 5.8%, meaning your monthly payments today on that exact same home are $2,816 a month, not the $1,650 a month, which is about a 70% increase in monthly payments on the exact same home in less than a year. But this is where it gets a little bit more interesting because we just got some new sales data that I kind of hinted at in the beginning of this video. And what the sales data has told us is that month over month, between June and July, we saw home sales fall by 5.9% month over month. But between July of 2021 and July of 2022, 1 year, we have seen home sales drop by over 20%. 20.2% drop in existing home sales. Why? Well, mainly here because of this growth in mortgage rates. Mortgage rates have gone up so much that it's making it so much more expensive for people to buy homes because now you have to borrow more money and you have to borrow the money at a more expensive interest rate. And mortgage rates are going to continue to go up as long as the Federal Reserve Bank continues to raise interest rates to fight inflation. This is where a lot of people are concerned about what's coming in the housing market and how much higher interest rates are going to go. Now, we did cover this whole story in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs yet, you have to join. If you are an investor, if you like to be financially aware of what's happening, Market Briefs is a free resource. It's completely free, where every day my team breaks down what's happening in the stock market, the real estate market, the crypto market, inflation, and the global economy into a fun, easy to read and witty newsletter. Even if you don't have a financial background, it is super fun, super easy to read, and we break down all the important stuff so you don't have to spend hours reading Yahoo Finance, CNBC, Wall Street Journal, Forbes, and every other major publication out there. We break it all down into a fun, witty, and easy to read email, and it's completely free. So if you want to join Market Briefs, I'll put the link to how you can do it down in the description below. Now, there are two parts and two reasons as to why we've seen such a drastic slowdown in home sales. Part of it is the mortgage rate increase. I mean, we've seen mortgage rates essentially double in 2022 by itself. But in addition to that, we also have to look at what happened in 2021, because 2021 also saw a massive boom in the housing market because everybody wanted to move into a home with a bigger office because people were working from home. People wanted to move out of suburbs, and then people wanted to take advantage of the super low mortgage rates because we saw the lowest mortgage rates that we've ever seen really in the history of time here in America. So people wanted to capitalize on these low mortgage rates, which created a massive boom in the housing market. So it's a two-part dilemma, because in 2021 we had a massive boom, and now we are seeing a massive slowdown because mortgage rates have gone up so much. This brings me to the question that everybody's wondering, which is what's coming with housing prices, and how come housing prices in my neighborhood either have gone down, or why haven't they gone down? Because while home sales have slowed down across the board, home prices haven't dropped across the board. You have to remember supply and demand. Now, I don't know why I wrote supply and demand like this. I thought it looked aesthetic, but anyways, you have to understand supply and demand, because in 2021, we had an excessive amount of demand. Everybody wanted to buy a home because mortgage rates were low and they wanted a home with an office in it. While at the same time, we had an excessively low amount of supply because people weren't selling their homes, and it was very difficult for builders to build new homes because it was tough to get materials and it was hard to find labor. So supply was low, demand was high, which pushed home prices up. Now what we're seeing happen in this 2022 market towards the end of the year is we're seeing demand fall. Demand's falling primarily because mortgage rates have gone up so much that it is much more expensive to buy a home because of the numbers that I just showed you. While at the same time, what's happening slowly is we're starting to see supply start to trickle upwards. And there's a couple reasons why we're seeing supply start to trickle upwards. One, in terms of building, the homes that were being built in 2021 are now finally starting to hit completion. We're starting to see some of that, where we're starting to see some homes finally get completed, which is increasing the amount of supply. But in addition to that, you have people around the country, especially in certain pockets, that are now scrambling to sell their homes. Why are they scrambling to sell their homes? Because they're seeing the same headlines that everybody else is seeing, that the housing market is slowing down. And they want to capitalize on the housing market while it's at the top. And so this is pressuring people to sell while they still can, because they already were thinking about selling, they wanted to sell, they wanted to move, and now they're like, oh no, things are starting to slow down, we need to sell as fast as possible. So you're seeing people that are now pressuring themselves to get their homes on the market. That way they can still get top dollar from their homes, which is why you're starting to see supply go up while demand is going down. Now this will impact prices. In some pockets around the country, you still have home prices that have not gone down. Why? Because the demand is still strong there. There are some neighborhoods, some pockets where people really, really want to be, and so the demand has not slowed down, which has continued to see home price growth. While in other pockets, you're seeing the opposite. You're seeing demand go down while supply is going up, which is causing some home prices to go down. Now, the thing that you have to understand about home prices is that the housing market is a very slow moving asset class. It's not like the stock market, where you can buy and sell a stock in the click of a button. Like, you can buy and sell the same stock in 2 seconds. In the housing market, it can take months to sell a home. And there's a lot more emotion involved. There's a lot more people involved. And the price of a home is determined by what someone else is willing to pay, not just what your neighbor's home sold for. This is where you have to understand that the housing market is much more slower moving. But the key indicator that you want to pay attention to is the Federal Reserve Bank, because the Federal Reserve Bank is the one that's controlling interest rates. And right now what they're saying is that they want to continue raising interest rates to bring inflation down to 2%. Well, as of today, the day of me recording this video, inflation is hovering at around 8.5%. And they continue to say that they will continue to raise interest rates until inflation comes down. Now, this is where you kind of have to think, what's going to break first? Is it going to be inflation, or is it going to be the housing market? Because the more you raise interest rates, the more it brings inflation down, because raising interest rates is one way to fight inflation, but raising interest rates also hurts the housing market, like we've been seeing happen. So what's going to break first? Is it going to be the housing market, or is inflation going to crack and inflation is going to come down before the housing market gets severely hurt? Now, it's difficult to answer that question with full accuracy because, well, the Federal Reserve Bank could also change their opinion. They might say, you know what, we have brought inflation down from the highs of 9.1%, but now because the housing market is getting hurt, we don't want to see another housing market crash, so we're going to start cutting interest rates. Like, if tomorrow, think about this, mortgage rates went up to 12%, what would happen? The housing market would crash. If mortgage rates doubled tomorrow, you would see a housing market crash very quickly. But at the same time, if we saw mortgage rates tomorrow go down to 2.5% again, what would happen? You'd see a housing market boom. People would go out and buy homes because they don't want to miss this opportunity to buy a home again. So this is where mortgage rates and interest rates very directly will impact the housing market. And the entity that you want to pay attention to is the Federal Reserve Bank. Now, this is one thing that we talk about in market briefs all the time, which is why if you haven't subscribed yet, make sure you do that. But the next thing that you have to pay attention to is also foreclosures. Because when you start to see an uptick of foreclosures, well, then that will also increase the supply. But the thing about foreclosures is you have to really have a reason to be foreclosed upon. Because right now, in today's market, most people have equity in their homes. You bought your home and the home prices have gone up. I mean, even over the last year, home prices have gone up significantly. And so if home prices have gone up since you bought your home, you have this invisible equity in your home. And so even if you lose your job, even if you don't have the ability to pay your mortgage, it doesn't make sense for you to get foreclosed on because, I mean, you could refinance. And even if you can't refinance, you can just sell your home and walk away with thousands of dollars in your pocket, even if you lose your job. So we're not in a market where foreclosures should be happening. But if mortgage rates continue to go up because the Fed is going to continue to fight inflation, well, then that will push the housing market further down. If the housing market continues to fall and people begin to lose their equity and home prices fall by 20, 25%, and then people go underwater on their homes, and that happens with people losing their jobs, with people losing the ability to pay their mortgages, now this can trigger a new wave of foreclosures, which can then increase the supply as well. This is where there are so many different aspects that you have to pay attention to, and we have to understand that no matter what happens, you also, I'm going to say this one more time, you also have to pay attention to the Federal Reserve Bank along with the government. Because now we have this X factor, which is the Federal Reserve Bank, which controls interest rates, but then the government can also influence the housing market because if you remember back in 2020, the government banned foreclosures. They said that the banks could not do it. And so that was the first time we've ever really seen that happen at that scale, at that extent. And so if they did something like that again, well, that would also influence the housing market. This is where if you're trying to buy a home, don't try to time the housing market. Instead, make sure you can afford the home that you want to buy and make sure that you can afford not just the down payment, but the monthly payment and the move-in costs. So this is where it pays to be educated about what's happening instead of making emotional decisions. And of course, we'll be keeping you up to date on market briefs. If you haven't subscribed yet, make sure you do that. Oh, you mean if I just put $1,000 into this investment, I can double it in 6 months? Sign me up. Then you have people who have no idea what they're doing start buying, and this causes a big bubble. So you start to see these booms and busts in paper assets, which can create opportunity for the people that understand what's going on, but it hurts the people who don't understand what's going on.